welcome to the Capital Discussions Roundtable. I'm Tom Nunnermaker with Brooks Rhymes, and today we're going to be talking about position sizing. Before we do, a quick disclosure, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, this is for educational purposes only. So it's good to have you, Brooks. Brooks and I have known each other a long time, but it's nice to have you on the round table to talk about an interesting subject, position sizing. It's not necessarily just for option traders. So welcome, Brooks.
Well, thank you, Tom. Good to be here. So let me here we go.
And I'll mute myself just in case our parrot makes some noises, but I'll be here and pop in and out as needed.
Okay. This is just a little bit about me. I think maybe the most relevant part here is the second point. So I approach trading from kind of what's called a systematic or a mechanical standpoint. So I'm one of the people that kind of believes in coding up my trading systems and then doing back tests and trying to, prove that a system will work. And it's one of the things that gives me confidence in order to be able to do that. Of course, one of the things you have to be careful about when you are back testing and creating trading systems is that you don't do what we call curve fitting or create a system that back tests well but will not test going forward into the future because you've maybe found something that only fits on the data of the past and not in the data of the future. So I'll talk about that a little bit more as we go forward. So this whole subject of position sizing is about the question, once you have a profitable system, the question becomes how many contracts or shares should be traded in order to maximize my equity growth yet control risk. So by that I'm talking about, we're trying to make as much money as we can, but trying to do it in a safe way. Okay, and when I talk about a profitable system, what I'm talking about is a system which has a positive expectancy. And so expectancy is basically the percent winners that you have times your average profit or average winning trade minus the percent losers you have times the average loss. So an example might be if you have a system that has 80% winners and 20% losers, and on an average winning trade, you make $100. On an average losing trade, you lose, say, $120. So your expectancy here would be 80% times $100 minus 20% times $120. And so that would be 80 minus 24 or $56, which is a positive expectancy. And another way to say that $56 would be the amount of your average trade considering all the winners and all the losers. So your average trade would be 56. Okay, and so what is a system? To me, a trading system has to be defined with specific rules. You don't necessarily have to code them up in a programming language, but you should have the rules in writing so that so the system is defined. And then in talking about back testing systems should be back tested in order to have statistical significance. And the back testing doesn't have to be automated. You can do it manually. in our area of trading, you can back test in option view or the option one product from Andrew, or you could perhaps back test in Thinkorswim or maybe in IB. But the back testing has to be reproducible. So in other words, if some other trader was to take your set of written rules, they should be able to come up with the same results that you did. So we're trying to get with a mechanical or a systematic test, we're trying to get the discretionary part of the trading or the judgmental part out. Or another way to say it would be if there is something that that might be discretionary in another method of trading, you would just need to define that as rules. Sometimes you can have additional rules that kind of take the place of the discretionary or the judgment. So, okay. So Tom, should I be taking questions as we go along, or hold them to the end, or what are your thoughts on that?
Well, I'll let you know if there are any questions that we need to do during the presentation, but
Okay.
None so far.
Okay, great. All right, well, we'll move along. So how many trades do you need to have a valid or a significant back test? And there's kind of a consensus that a minimum of 30 trades are needed in order to have significance for it to be enough trades for you to have some minimal amount of confidence that what you're looking at, is part of a set of trades that you could just, I guess, like I said, have some confidence. And it's actually a lot better to have more trades. To have 100 or 200 trades is much better than having the 30 trades, and it increases the confidence in making decisions based on the back test results. If you are automating your trading rules and you're doing using the computer to help do the back test, then it's much easier to have a sample size of 100 or 200 trades. Having done quite a bit of manual back testing, trying to do a manual back test of 100 trades using option view is a whole lot of work, and probably many hours of manual labor. And at least for myself, I find that when I do that, eventually I start introducing a few mistakes here and there, just because, it gets repetitive, you get tired, your eyes get tired. And so if you are able to do back testing using some type of software for back testing, it does eliminate some of the human error. Okay, and then what periods to include in your back test? You do have to be careful when you're back testing that you don't just back test one type of market. You want to try and include all types of markets, bull markets, bear markets, trading ranges. So, that's something that I've evolved and am more careful about than perhaps I was in the past. You see some kind of market that's maybe bullish in nature, and you do your test there. Later, when the market turns bearish, you may get surprised because you may have created some trading rules or something that will work well in a bear market but don't work well in a bull market, not in a bear market. So you do need to include all types, and you have to remember to include the trading range markets where the market just moving sideways for some length of time. It's important to include those in there because you can get a lot of whipsaw type trades in those trading ranges where maybe you're not losing money, but you're not making very much money either. And so maybe, you can get eaten away sometimes there with some of the commission costs. And the last point is just in if you don't include all those types of markets, then the back test results really are are misleading and can be incomplete. I found for myself that it's best to test each symbol separately. If you're trading multiple symbols, and sometimes we do use rotation strategies, where we're using a number of different symbols, but it's really best to test them independently, and maybe even more so with stocks where symbols can cease to exist. Sometimes if you go back and you try and do a 5 or 6 year test, you may start out with the NASDAQ 100 or the S&P 500, the individual symbols, particularly if you're doing some type of automated testing, and find that some of those symbols disappear over time. Maybe 2 years ago, a symbol disappeared because the company got acquired, or perhaps it went bankrupt. So it is good to test them individually. A lot of us are trading things like the RUT or the SPX or the NDX, and so if you're doing that versus stocks, then it's not so much work to test them separately. Okay. So why even think about position sizing? Why not just trade the same number of contracts with each trade that you do? Well, you certainly can do that. It's simple that way. It's easy. But it doesn't really take into account the current equity balance. So if you have a string of losers in a row, and if you keep trading the same number of contracts, maybe that's not the wisest thing to do. And also, if you have some ideas to the risk of the current trade, and perhaps it's a larger risk than previous trades, maybe again you would want to modify the number of contracts that you're trading to take that into account. So if you, and another thing is, if you're trading the same number of contracts each trade, even when you have winners, your equity is going to kind of grow in a straight line. It's not, less the losses that you have, but you're not going to see any type of curving equity line, where you're going to have any type of exponential growth. And we'll see an example of that coming up here in a few slides. Okay, so position sizing is a defined method for determining the number of contracts to trade, which may take into account factors such as the current equity balance, risk of the current trade, and whether the previous trade was a winner or a loser. Okay. So just like a systematic person or a systematic trader will have rules for their trading system, they'll also have rules or formulas or calculations for how many contracts or shares to trade. Okay. And position sizing goes back to a fellow by the name of John Kelly, who was a scientist who worked at Bell Labs, and you can see that he came up with this quite a while ago, and maybe some of you have heard of the Kelly formula, and you can read here a little bit. This fellow had an interesting background here, gunslinger, daredevil. He was from Texas, which can explain some of that. And then a little further down, they talk about Ed Thorpe. So maybe some of you who are interested in poker or blackjack, have heard of Mr. Thorpe. He wrote a pretty famous book called Beat the Dealer, and then later he went on and wrote a book called Beat the Market, and those are kind of famous books in the area of risk and chance and gambling. And when you think about it, in some ways, our trades are a lot like gambling. I guess we don't want to think about them as being like gambling, but in many ways, when we place a trade, it's kind of like placing a bet. And we like to think that maybe we've got more control than we do if we go into a casino and spin the roulette wheel. But, we'd like to think that we, have put some intelligence, behind our trades, and that we have found some type of edge that we think is going to give us better results than random chance. They talk here about how some of John Kelly's work, has been used by people like Warren Buffett and Bill Gross, who was with the bond trading hedge fund on the West Coast. And let's go on from here. Okay, so the two position sizing tools that I have used in my trading, the first one I used was a product called ProSizer from a company called Unicorn Research. The author is Alex, and I have a link there if you'd like to go look at that. It's really an inexpensive program. It's only $37. It's actually an Excel spreadsheet, a pretty sophisticated one. It's inexpensive, at $37. It's a great place to start. And I think you can download that and play with it a little bit before you actually have to pay. So that's something you might want to look at. And then the other product that I use, and Tom and I were talking about this before this presentation. Tom has also used this product and is familiar with it. It's called Market System Analyzer from a company called AdaptTrade. And the author is a fellow named Mike Bryant. And I've included a link there to that product. That one's a little more costly. It's $350, but he has a 30-day free trial where you get to try all of the features. It's not limited in any way. So for the 30 days, it does everything that it'll do after you subscribe. It has a ton of features. It's really a nice product. We're going to see a couple screens of it. It's a very good value. I tell people that it's probably the wisest $350 that I've spent on trading, in the 20 plus years, that I've been at that. I don't have any financial interest in either of these products. I'm just a happy customer. If you go to the AdaptTrade website, besides seeing information there about MSA, Mike Bryan has written some great articles about trading, and they're free, so you might want to look at those while you're there. Okay. So here are the position sizing methods. First, ProSizer, and you can see ProSizer offers 5 different methods: fixed lot size, fixed fraction, fixed ratio, risk a percent of your equity, volatility percent of equity, and of course, if you download and look into this product, there's explanations for all 5 of those and exactly how they work and what they do. MSA has a richer set, as maybe a more full-featured product. You can see there a list of all the different ones that MSA offers, and you can see some in common, like the fixed fractional. They both offer fixed fraction. That's the one that we're going to look at in a minute. It's a very popular one. Mike Bryant has told me that it's one of the ones that he favors, and I consider him an expert on this subject. And so here's some information about fixed fractional. So the idea behind this is that the number of shares or contracts that we're going to trade is based on the risk of the trade. So sometimes I call it fixed fractional, sometimes I call it fixed risk. It's really the same thing. And we have a little example here where you might risk 2%. That's a very popular thing. I'm sure you've all heard, by risking 2% on each trade, it's going to take 50 losers to bankrupt you. So that seems pretty unlikely. So that seems like kind of a good thing to limit your trades to. Let's see. I think I just saw a question about maintenance fee on those two. I'm not sure that ProSizer has been updated in a long time. Mike Bryant does update MSA pretty regularly, and I don't think that I've had to pay a fee for any of the upgrades on MSA. I think they've
I haven't either. I don't think there
yeah
is a maintenance fee for that.
yeah. I think
It's
he has
probably a mistake from him, but
yeah, and it's nice because I mean, and usually when Mike upgrades it, they're not normally bug fixes. There's some additional features that he's put into it. So I think the current version is 3.5. But
that sounds right.
does that sound right? Okay. Okay. So and yes, and probably some of you have probably read Ralph Vince's book, Portfolio Management Formulas. That's a popular one where he gets into risk and talks about what percent of your equity you should be trading or what percent you should not be trading. Let's see here, and so we have an example here where we have a stock trading system with a 2-point stop. So it might go long if the price was at 48 with a sell stop at 46, so you wouldn't, lose more than 2 points. So the risk per share would be $2 per share with a fixed fractional system of 5%. Now the 5%, you might be wondering where that comes from, and that's kind of from doing, that's what you would use MSA for, is to try different percents for fixed fractional. You might try 5%, 10%, maybe by 5% steps all the way up to 50% to see what you think works well for you. As you increase the percent, you're getting more aggressive. You're going to trade more shares, but and so you'll earn money faster, with your profitable system, but you'll also have deeper drawdowns. So, we talk about this a little bit in the next few screens. It's your comfort. It's your comfort level with looking at the position sizing and deciding how many contracts to trade. But so here we're saying your account equity is $20,000. So it would risk, so we see we have a little formula down there, N equals F times equity divided by trade risk. So here, if we're saying that 5% or 0.05 times the $20,000 in equity divided by the $2 per share you would lose or that you're risking, this would come out that you should trade 500 shares. So it's one way to approach shares, and we'll see an example of this in a slide or two. And they talk about how this particular sizing method makes sense with leveraged instruments such as futures and also options. So let's take a look. So this is a screenshot from Market System Analyzer. So what we have here are 178 trades that I imported into Market System Analyzer from a test that I ran. And MSA makes it very easy to bring trades into it. They have an import function, and basically you would just need to save your trades like into a text file, like in a CSV format or a TXT format, or I think also an Excel format, and they have a really nice little import tool that will allow you to pull your trades in. So here we see, that this is a profitable system because we start with $8,000 and it builds to an equity high of $57,000. So this system makes a net profit of $49,000. The places where you see the darker blue, those are losses, and you can see that Some of them where they're wider, those are deeper drawdowns. One of the things you might notice, can you see my pointer, my cursor?
Yep, sure can.
Yep. Okay, good. So so at the point that I'm pointing to, so here we have several losses in a row, which causes us to drop down, and but you can see then the winning trades start again, and you start seeing these vertical lines when you get a new equity high. So as soon as we basically recovered from the drawdown, then you start seeing these little vertical lines going up again. So so this is a pretty good system, but like any system, it's going to have its periods, where it's going to lose some money, and you just have to be patient and have the confidence that that it's going to start making money again. So now we're going to take a look at the next slide, where we are using position sizing. So this one we're looking at right now, there's no position sizing. We're trading 5 contracts every time, and you can kind of see that down here in this area. The number of contracts is 5, so we're trading it consistently 5 contracts. Okay, and so this is a screenshot from MSA where we've put fixed fractional to work. So again, we're starting with $8,000, and we're building up the number of contracts that we trade. And it looks like we're starting with, I believe, 2, and we build all the way up to 24 contracts. And so what the system is doing here is it's actually trading more contracts as our equity grows. Now, this particular system, the risk on each trade was pretty much the same. So the risk wasn't as big a factor with this one as was the fact that the equity was growing, and as our equity grew, it started trading more contracts. And so this one made some more money. And I'm going to compare the two on the next slide, so you can kind of see what the difference is. But the large point here is to notice that as we go, that we start getting into a nice exponential area here, and you can see that that we're getting some nice growth here in an exponential way that we didn't get on the previous slide. You might also, some other things to notice that are important is like in the areas where we're having some losses and drawdowns, like right in here, you can see down here that it pulled back in the number of contracts that it was trading. So it kind of pulled back, and then it stayed pulled back until we started making some money. So as the winners kind of grew here and started to return us back to a new equity high, well, then it started increasing the number of contracts that we trade. And as we continue to win more times, we get to the point where where it's trading even more contracts. So any questions about this before we go to the next slide? Okay, all right. Okay. So here's kind of a comparison between the two graphs that we were looking at. No position sizing versus the fixed fractional sizing. So in both cases, we started with $8,000. With the fixed fractional, you can see that we grew that up to $66,000 versus $49,000 for no position sizing. We had the same number of trades. The maximum number of contracts changed. We had 5 for no position sizing, and we eventually grew up to 24. Now, we do have a larger loss with the fixed fractional sizing, and that really makes sense when you think about it, because if you're trading more contracts, if you're trading 24 versus 5, when things do go wrong, when you do have a loss, they're going to, it's a loss on a larger number of contracts, so the loss is going to be larger. But our average trade profit and loss for both winning and losing trades has grown by almost $100, which is a good thing. The drawdown also increases, and here it is a pretty substantial increase in the drawdown, both when you look at it from a dollar or a percentage standpoint. So it is increasing quite a bit. But you can't really avoid that. If you're trading more contracts, then your drawdowns are also, and you're are going to get larger. I'm sorry, both from a dollar and a percentage standpoint. So there is no free lunch. You have to be able to live with the eventual drawdowns, when you're using position sizing and you're trading more contracts. Okay. And so here I have some things, some books that you might want to look into if this subject is of interest to you. Bob Pardo wrote a book back in 1992. It's kind of a classic, The Design, Testing, and Optimization of Trading Systems. And in there, he does talk about position sizing. I think my Ryan Jones, he also wrote an interesting book called The Trading Game, Playing by the Numbers to Make Millions. I can't guarantee that, but that was after Bob Pardo's book. And then there is an author named Howard Bandy who has written several different excellent trading books. And any of you who have used a broker, or sometimes I hear it pronounced Ami broker, that is a great product for back testing with. It's a very inexpensive product. I think it's $250, and it's similar in the way that it works to TradeStation. There's some pros and cons of using it versus TradeStation. One of the positive things about a broker is that it just runs lightning fast. So if any of you are TradeStation users and you do large back tests and find that you're waiting, minutes for a back test to finish, doing the same test in a broker, it runs in a second or two. It's amazing how fast it is. And Howard Bandy, I'm mentioning that because he's also a big fan of a broker, and he has some program code for a broker in the different books that he's written. So, I see someone else here that's listening likes a broker. Yep. And might also mention with a broker that the support is just fantastic. There's a fellow named Marcin who answers most of the questions, and it's just amazing how well they answer the questions that you ask them and how quickly they do it. I usually get answers back in hours, almost always the same day. Rarely does it go into the next day unless I'm asking late in the day, but they do just an excellent job of supporting that product. And I guess I'd like to open things up for questions now.
I think I don't see any other questions, but I did have one as far as do you think you could show like an example of importing trades into MSA just so people could see how that's done?
Sure. Let's see here. So let me.
Nothing like a visual.
Okay. All right. So this is the program itself. So when you want to import trades, you go up to the menu and you click on Trades, and then you click on Data Source. Okay. And so So here is one where I've kind of already done the definition, but let's see. I wonder if I could maybe I can just redo it here. I think maybe I can probably select the same file over again here. So. Okay, and so here I have several different files that are in CSV format. Let me see if I can. Comma separated values, which is a one of the ways that Excel will export. I'll just say save here. Okay, and so here is how you you bring things in, and it has already kind of figured this out. Maybe because I've done this in the past. I wonder. Let me just try something here. Let's just do a new MSA file, and I'll just do this afresh. And so I think now, even if I pick the same file, I think I'll be able to. Okay, so here we are. Okay, so in the file, the first thing here is the symbol. So you can see here, this is the Russell. So right here, I just go in and I find the symbol. So what I'm doing here is I'm telling it that this column is the symbol. And then here, this is the entry date. Okay, and you can see how easy and how friendly this is. And this is the entry price. And then we'll come over here. And we've got the exit date. And we've got the exit price. Okay. And I'm not sure what that is. That's not important. This is our profit and loss. And this was the risk of the trade. So I think this was like a 10-point spread. So the risk would be the difference between, like $10,000 and then the amount that I collected on the, this would be like a credit spread. And this, I think, is the number. This was the size in contracts. And yeah, I'm not sure what this one is. But I think I've probably defined enough here that it's going to allow me to import it. Now, in the actual CSV file, the first line has my headers in it. So what you do is you come down here to the bottom, see where I'm check marking it here, skip the first, and I tell it skip the first one line. Well, now it's going to ignore the headers that are in the CSV file, which or just make it easier if you opened up the CSV file like a notepad or something. And so now I can say OK, and say OK here. And here you can see it's imported the trade. So this is very much like the one that we were looking at earlier. This one has 10 contracts instead of 5. And then you can do things in here like I like to come in to format the chart, and I like to tell it to mark the new highs in the equity. Okay, and there you can see those are our white lines again. And then you can also, and so here, what you can do, this is so feature rich. It's just, it's amazing the things that you can do. He has these dependency rules where you can come in and you can say things like, well, it looks like that winners follow winners, and maybe in some cases losses follow losses. So you can play with things. You can say, okay, maybe after there was a well, we could even play with this for a second. We could say, okay, after one loss, let's skip the next trade. Okay, because we see here that quite often, maybe there's 2 or more losses in a row. So you can say like that, and so it just automatically adjusted, and you can see whether that helped or hurt your net profit. So our net profit is now 54,000. We can go back and we can take that back off and see whether the dependency rule helped or not. So I'll take it off. Let's see if the 4,000 goes up or down. Okay, and it looks like it actually hurt us. So maybe that wasn't a good idea. But you can see how quick and easy it was to try out that idea. And we have position sizing. Here's all the different position sizings that you can do. And you can also basically do an optimization on the position sizing. Parameter studies. Let's see, where is that now? We have some Monte Carlo analysis in here. Just undo that. One of the things that I really like about MSA are these performance results. So you can see here that we had a starting equity of the $4,688, and he's got this very nice summary here where he shows all the different information about, and if there were short trades, he would show those, but I've got these coded as long. They actually were short trades, but that's what that -1 was for. That was to indicate that these were short trades. So I actually could go back and fix that here quickly. We go back here and we edit the data format. That's what this was here. If I tell it long short here, and then I tell it to save this, tell it okay. So I want to replace it, and I want to turn off this Monte Carlo thing. Yeah. Oh well, stuck with it for now. So going back to the performance results and looking at the summary, yep, we can see. So now it treated, these are all short trades, so it now has the right header there. And it shows, how many total trades there were, how many were winners, how many were losers, the average amount of winners, the average amount of losers. He also has these very nice return tables. I like these a lot. So you can see whether did you make money in every year, So this is really nice. A lot of the backtesting products, they don't necessarily show you this, by year. So this has it by year, has it by month, and then further down he has it by day and week. So it's really a nice product. Here he has some information on dependencies, and has a confidence level of 99.86, and so this is saying that that based on statistical calculations, that he does feel like this is a profitable system. So,
hey Brooks, Teddy had a question. He can understand this for stocks. How would you test this on options when you don't wait until it expires? Example, a road trip, M3, Mango. I guess when you have to calculate the P&L and the entry price and the exit price, how do you do that for a complex option spread for this?
Well, that's a good question, and this probably might not be, if you're doing complex option spreads, and particularly if you're doing adjustments and you're basing them on discretion and judgment and analysis that you're doing in option view and looking things up and making decisions, if it's so complex that you couldn't write the rules down for the type of trading that you're doing, it wouldn't work, because this is all predicated on you working with a system. Now, on the other hand, if you're doing a type of trading, and maybe it is something that's not too terribly complicated. Maybe you're doing some type of iron condor, butterfly, or calendar where you can write hard rules for that. It is a good question. What do you do if you're starting trade B before trade A has finished? And so trade A has unrealized gains or losses, but it doesn't have finalized gains or losses. You really have to wait for trades to finish in order to be able to, put the input into this program in order to have it help you with the position sizing. So,
I think you could also use it, if you put in your live trades, you can see how you're doing historically and track that. Like Bruno had some friends who were running hedge funds, and they said they wouldn't look at any system unless it had been run through this with their live trading results.
Right.
So yeah, it's a good tool to analyze a trading system results, either back tested or live.
It is. It's a very nice piece of software.
Now, there was another question from Andrew. He says, after this many years of system development, what particular position sizing method have you settled on?
Well, I had been using fixed fractional up until recently, and I started looking into a one that's actually not in MSA or ProSizer. It's called anti-martingale. And I don't know if any of you have ever heard of regular martingale. I mean, that may strike fear into some people's hearts to hear about that one. But the martingale strategy, so what that would be like, if you went into a casino and you went to a roulette wheel, a martingale strategy would be every time that you placed a bet and you lost, you would double the amount of the next bet. Okay. And theoretically, that the martingale system should make money. Of course, it won't make money in a casino, for two reasons. One is that the casino on a roulette wheel has 0 and double 0, where whether you place black or red as the bet, you're going to lose when the 0 or double 0 comes up. The other reason is that casinos put limits on the amount that you can bet, like at a roulette wheel. So eventually you're going to have a loser that's so large that if you tried to double the amount of the next bet, you're going to run into the casino's limit, on how much you can bet. And there's a saying somewhere that the market or the casino or the roulette table can stay irrational longer than you can stay solvent. So now let me tell you about the anti-martingale. So the anti-martingale works basically in the reverse of the martingale. So every time that you have a winning trade, you would increase the amount that you're betting. So let's suppose that you started with let's say 2 option contracts. So if your first trade was a winner, you would the next time trade 4 option contracts. And if that was a winner, you would go to 8 option contracts. Now, when you have a loser, what you would do is you would cut your number of contracts in half. So after having the trade with 8 contracts, if that one turned out to be a loser, then you would drop back to 4 contracts. If that was a loser, you would drop back to 2. I've been doing some, I've done some computer programming simulations of this, doing iterations and doing Monte Carlo runs, just from custom software I've written, and it works very well. What you have to do is you have to kind of decide, what is your minimum number of contracts. Maybe you don't go lower than 2. Obviously, you can't go lower than 1, but you could start at 1 contract and then go up from there. You also need to set a maximum number of contracts at some point. For myself, I'm comfortable trading somewhere around 16 to 32 contracts on the Russell, and just at this point in time, I'm not, comfortable in trading more than that number of contracts on one trade. So, you do have to limit it on the upper side. You obviously don't want to get to a point where you're trading 256 or 512 contracts or some power of two that, maybe goes beyond, your margin ability and maybe beyond your comfort level. So you might want to look, maybe you can Google anti-martingale and see if that's for you.
Okay, there was another question from David. He asked, what risk management techniques do you use besides position sizing, I guess, in anti-martingale?
Well, I would say this is, I guess I use time as a stop in my trading systems. So basically, and this is a whole nother question. There's a big question as to whether stop losses are a good idea or not. And theoretically, it's good to have a stop loss. To have a max loss. And I know a lot of times, in the world, that we've all come through, we've heard about having like a 2x max loss or something like that. And I do agree with that kind of theoretically, but I've actually found in some of the back testing that I've done that max losses actually hurt the systems that I've been back testing on, and I tend these days to lean a little bit more towards having more of a time loss. So if a trade doesn't do what I would like it to do within a certain number of days, so many days into the trade, to just close it out that way. And I've found, at least in most circumstances, that that it hasn't resulted in catastrophic type losses. So that's one of the things I do to limit risk is I will close out a trade if it doesn't perform as expected, within a certain number of days. And usually what I'm looking for it to do is to make a certain percentage of profit. So I might set, that I want it to make, I don't know, like with a credit spread, I might want to try to capture, a certain percent of profit, within a certain number of trading days. And if I don't do that, then I will just move out of the trade. I'll just close the trade and go on to the next one. One of the things that I found is that trading more frequently is better. So now that we have weekly options, I find that it's much better to trade weekly than it is to trade monthly. And one of the reasons for that is that, your drawdowns tend to be shorter. If you're trading on a monthly basis and you have a losing trade, you basically have to wait till the next month to try to regain, the dollars that you lost. And if, forbid, you have two losses in a row, it may be, 2 trades or 2 more months to break even and maybe a third month in order to get ahead again. So by trading on a weekly basis where you're trading 52 times a year instead of 12, you can recover from drawdowns a lot quicker, on a calendar basis. So I tend to favor weekly trading. So I don't worry so much about having a losing trade. If I have a losing trade, then I just close it rather than trying to, do Herculean adjustments to it to try to bring it back into profitability. I would rather just close a losing trade and go on to the next one. And I know that may not fit everyone, depending on your philosophy and your trading method and so forth, but that's something that works for me.
Yeah, as long as you keep the losses small, that works great.
Yeah.
And Srini says most of the hedge funds use vol targeting as a risk management. Just a little piece of information there.
What type of targeting?
Vol targeting.
Oh, vol targeting.
So maybe something to look at.
Yeah.
Well, that's it for the questions. We're coming up on an hour, so it looks like a pretty good time to stop. Do you have any last words before we wrap it up, Brooks?
No, I've enjoyed doing this, and I thank you for having me, Tom, and I thank everyone for all the questions. It's been very enjoyable doing this.
Oh, we can certainly have you back on again if you have more to talk about.
Okay, and it's fine with me, Tom, if you would like to, put the PDF, on the website for people to download, and somewhere in there, I think on page 3 is my email address. If anyone would like to send an email about this, and I'm also in the CD forums there. If anyone wanted to start a thread or ask questions there.
Fantastic. Well, thanks again, Brooks. Thanks, everyone, for sticking with us. I hope you enjoyed the topic. It's a little different than the normal option trading topic, as this applies to all types of trading. So thanks for the info, Brooks. Really appreciate it.
Okay. Thanks, Tom. Have a good day, everyone.
All right. Thanks. You too.